Welcome to Zen and the Art of Real Estate Investing, one of the fastest growing real estate investing podcasts in the world. What if you could learn from experienced real estate investors? Find out what got them to where they are now. Get insight into their daily habits and take these insights to inspire your own growth. Each episode, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor and the founder of Streamline, a data-driven, investor-friendly, independent real estate brokerage located in Madison, New Jersey. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, this is the free mentorship program you can take with you anywhere. Now, here's Jonathan.
Welcome back to another episode of Zen and the Art of Real Estate Investing. I'm excited for you to hear this show as we transition to this financial mindfulness and wealth generation ideation. And we're talking about long-term thinking a lot on this and a lot about the difference between noise and information. I think you're going to get a lot out of the show. You need to open your mind and see, are you taking in information or are you listening to a lot of noise? And how can you change that for the better? Let's go. This is episode 365 of Zen and the Art of Real Estate Investing. And we have a solo show for you today, how to think like a long-term investor when everything around you is noise. This show is really important to me as we begin the transition from what really was a full-on real estate show to now what we're calling financial mindfulness, wealth generation, wealth preservation, but also real estate. We're not abandoning real estate at all. So we're really transitioning here by talking about mindfulness practices that will help you get better as a real estate investor and therefore grow bigger wealth or smarter wealth, because it really is different for each person. And that's going to be something we're probably doing a show on next episode or the episode after. The fact that wealth and financial freedom is different for every person. So look out for that either next or the episode after. Remember, we're now once a week on Wednesday as we've pared down so I can focus and build differently. So when I came up with this, how to think like a long-term investor when everything around you is noise, the noise is really the important part. So I want to start defining what I think noise is, especially in this space, but it's really everywhere. So I'm talking about market headlines, social media, of course, hot takes, rate panic, and everybody who thinks they can flip a house, which again is all part of social media and what you see, TikTok, short takes, quicker information. Noise is like Blinkist is to a book. Blinkist is a summary, but if you want to enjoy the book, you read the whole book. That's long-term. That's a long-term thinking. I'm going to sit down, read a whole book, or I'm going to listen to a book on 1x. Because I used to listen to books on like 1.5, 1.8x, and I was missing a lot of information. And if you're consuming your real estate content on TikTok and it's 26 seconds, or even YouTube, and you go to watch a 12-minute video and you only get 2 minutes and 11 seconds, and I know these numbers because I look at when people check out of videos, you're not getting all the information, and it will encourage you to think shorter because you're watching shorter. The less amount of time you spend consuming information, the less amount of time you're going to be able to confidently dissect that information. And that's a really important part of the mindful approach to real estate investing is to understand that you have to slow down. And in order to slow down, you have to put on some headphones sometimes and reject all the noise that is out there. You can't doom scroll. You can't believe in headlines about real estate is X across the country, or this is a buyer's market, this is a seller's market. It's great to invest in America. None of that makes any sense because you can go back and listen to my episode about real estate being local, and it's all in there. That's it. You need to tune out the headlines. You need to tune out the social media. You can get benefits from social media, but you want to make sure that you're doing verification on a lot of this stuff. You know, if you're chasing highlight reels and want to get into that Lamborghini culture, most of the time it's not going to go well because you're chasing. And chasing is not a great thing. We just talked about that on another episode. So long-term thinking is how I've always built, and I think that's really the way to build wealth. That's wealth generation. It's also wealth preservation, is planning, thinking long-term, not focusing short-term. So why is it that short-term thinking is really the default, and how do you rewire it to adjust yourself? I think with all that's out there for the modern investor, it's easy to see why short-term thinking is the default. It's just easier. People want a quick fix. They'd rather the lure of, I mean, look, I invested very little in crypto, never bought any NFTs. I don't invest in meme stocks because it's an elevator and a very small percentage win and most lose. And that's not good for me. That's never been the way that I invest. I'm not saying that I don't take risks, but I'm very comfortable with long-term investments. I've owned properties for very long times without any problems at all. And I like them. I like an asset that continues to churn over time. I think it's important. But I look at people now and I understand how they got to short term, because short term is just right out there for you. It makes it sound easy. Isn't that what the FIRE movement is? Financially independent, retire early. I mean, like, what's early? Once 20-year-olds start talking about that, I think it's a problem. That's short term. Even thinking I want to retire at 30, that's short term thinking. What are you going to do the rest of your life from 30 to say 70? Spend all your money? I guarantee you're not going to you didn't make that much money unless you hit it, on selling a startup or something. And then you could still burn that money. Why do lottery winners, most of the higher percentage, more than 50%, probably like 60, 70%, why do they run out of money within just a couple of years? Because they're not thinking long term. They're thinking short term. They're thinking rewards. And everything is a reward now. You can get a reward for everything, but it doesn't really mean anything. I always use the mayor on Yelp analogy because I used to be a mayor in lots of places on Yelp. I was really into Yelp about 15 years ago when I came back to Brooklyn. I just found it fun. I knew a lot of people, went to all these Yelp Elite events. But, when I look back at it, what did I really think I was getting because I checked in at the bagel shop more than everybody else? Nothing. I mean, it's a digital badge. And a lot of these short-term rewards are just digital badges. It doesn't really do anything. Wealth generation is under the radar. I always mention this book. Go read it. Millionaire Next Door. None of those people are making social media content. I mean, a lot of them are dead now, but it's not something they would ever do. I can't imagine thinking back to my dad, even when I was a kid. So he would probably be like maybe 40 when I was little. I can't imagine my dad. I make lots of videos. Like, I cannot imagine my dad making a video. It's silly. He was just worried about gaining assets and holding them for as long as he could and making sure that they made money. And that's also how you should be thinking. But you also want to think about how you design the plan. And you have to do that by thinking long-term to start. And what's your long-term goal? If you're in your 20s, what's your goal for when you're 70? If you're not thinking about that, you're not thinking out there long enough. I'm not saying you need an annual plan from 21 to 70, but you need to kind of figure out what you want in the end. And if you don't have kids, sometimes it's hard to think of what you want for your kids. But I can guarantee you from my own experience with a 24 and a 22-year-old, the second that first kid comes out, you start to realize your job is to help them build a better life as well. And part of that is to earn as much as you can to provide for them until they can provide for themselves. And it's a different world now. Things are more expensive. So I'm very happy with the way that I've planned because I know that I can support my kids until they can support themselves well. And that can change over time. People can lose jobs. Anything can happen these days. So part of the important definition is a lot of people think that the noise is actually information. I think there's a giant difference between information and noise, and I want to explain how to tell them apart. So noise is shorter. Information is consumable in longer parts. So I'm not saying you can't get information from a TikTok video, but it's not going to be full. You can't learn about Section 8 rentals in 31 seconds. I mean, that you can't. You need to do a deep dive. That's why podcasts are great. Podcasts, to me, if you're at 30 minutes to 60 minutes and you're listening to the whole thing on 1X, That's information, depending on the content. I mean, not all podcasts are going to be great. Some episodes are better than others. Some podcasts are better than others. Some are more informative, but it's certainly not noise unless it's intended to be noise. The ads in the middle of podcasts on some of my favorite shows, that's noise. I find it really annoying when I'm trying to lock in on like a very mindful episode and then there's like a slot machines ad. It's just horrendous. I'm fine with athletic greens and those products fit, but I just hate when the product doesn't fit the podcast. So that's noise to me, but information happens in a podcast because it's long form. I think reading things gives you a lot of information, but when you're reading, you have to consider the source. Now, the source can change depending on what you believe is, how you believe that source is. It can change it from noise to information, but there's always a middle ground. And the middle ground is reality. So what I want is facts. And in real estate, to me, facts come from data. So I look for verifiable data. That doesn't mean that like Zillow's data is not correct. Redfin's not all correct, but you can start to piece together a picture when you use multiple data sources, and then you start to learn over time how to get the best information. That's really important because when you learn how, just like you learn how to prompt AI better to make sure you're getting all points of view, you can learn how to get the best information. And you can use different sites that are more reliable. Now, nothing is 100% reliable these days, but you want to hedge your bets on working on multiple sources to see if it makes sense to you. And you don't want to discount your own personal knowledge. Your own personal knowledge is really the best information source and certainly not noise. But the more that you spend time skipping from one thing to another, you could basically spend your whole day multitasking. And then you're never going to lock in and really look through that 40-page portfolio, the 40-page PDF on the syndication that you want to invest in. Maybe now you outsource it to AI, but AI is also imperfect. I like it. I'm doing a lot more with AI, but you can't put that in there and just say, oh, it says go. I'm just going to send $100,000. Like, you got to verify what's in there, check the document, go over it a little more. So can you cut down time? Yeah, sure. I think you can cut down time and still get information and it not be noise. But to me, what's noisy is what's yelling at you, and what's yelling at you is social media and talking heads and all the videos that are encouraging you with a purpose. They have a specific call to action for you to do something. I'm pretty proud that at 365 episodes, I don't think I've really asked anyone to do anything. Occasionally in the middle, I have an affiliate link. I can tell you, I'm not running to the bank on my earnings, but I really believe in those companies and I use them. So I promote them and I get a tiny chunk when something happens. And I feel like that's totally fair, but I don't run ads and I don't shill for products. And I think what's very noisy in the real estate investing world are funnels. When you realize, wait, I'm actually in a sales funnel right now. This is MLM. I don't want to be in a sales funnel. So you really have to start to separate the difference between information and noise. Noise is just a mess. It's not really able to be verified because there's not enough even information in the noise to verify it. Information you can verify from multiple sources, and you want to focus on data in real estate and in wealth building. So what do long-term investors actually do differently when the market shifts? I think that's an important one because sometimes the market shifts and someone will say, oh, well, now what are they going to do? In my opinion, and across 364 previous episodes, for all the people who've never had a bomb, like never went bankrupt, it's across the board. They just buy real estate and wait. It doesn't mean that they don't trade off and on, but they bank on the assets that they believed in and they hang on to them until they can trade them up for a certain profit that makes sense, that they can snowball it into something bigger. That's real estate in a nutshell, the snowball. Can you keep rolling the snowball till it gets bigger and bigger without throwing it down the mountain? That's the whole point of long-term thinking. You have to keep the snowball in that little groove so it keeps getting bigger. I think what long-term investors do different when the market shifts is they don't panic. And I have panicked before. I'm sure if you've listened to podcasts enough, you know I panicked in 2008, took all my money out of stocks, left it in cash. Dumb idea, probably lost an enormous amount of money by just letting it sit. However, I didn't lose an enormous amount of money. So at least I was smart enough to do it that way. I could have earned a lot more, but I wasn't losing more. So that was important. Still not the right move, but I feel that long-term thinkers never panic. They know that something's coming. And actually, when everybody else starts panicking, guess what? That's when the long-term investors show up and they buy all the stuff. It's a no-brainer. Ask any of them, listen back to the episodes. When everyone else is panicking, that's when the smart people step up and grab all of the panic sales. Think about it. That's long-term thinking. Short-term thinking is, a crash is coming. I need to get rid of everything. Occasionally, sometimes you have to really like save your finances. But when everybody's getting rid of stuff, there come the savvy buyers who haven't been riding the roller coaster the whole time. They're just hanging out, always looking, always seeing when the deals come, and then the deals start pouring out and they're going to grab them. Let's see. Why patience isn't passive? It's an active daily decision. So long-term thinking is built on patience. I'm a big advocate of being patient. Obviously, when you're a child, it's very hard to be patient. If you want the candy, you want the candy. I mean, just look at the old the marshmallow experiment where they put the two marshmallows on the table, leave the kids in the room and see if they'll eat them. And they're just like a couple badass kids who just don't do it. They don't eat the marshmallow. They're like 5 years old and they like sniff it. One of them was licking it. They just don't eat it. They hold out because they want to get a second marshmallow or something like that. But to me, patience isn't being passive. And sometimes people think that when you're patient and you're not buying, that you're being too passive, not in terms of passive investing, but like passive as a person. But it's not true. Patience is long-term thinking, letting other people jump in, and maybe you miss a couple deals. When you're patient and you're a long-term thinker, you're going to miss plenty of deals over the years. That's part of it. You can't win them all. And if you think you're going to, you're probably going to lose. So by being patient, that's actually being active, not passive, because you're reviewing. And for long-term investors, they're always looking at the market. They're always looking for deals. They're always reviewing deals, and they're passing on deals because the deals don't make sense, and they're not trying to force them to pencil on a spreadsheet, and they're not making it not pencil. If it pencils based on their formula, they're going to take a deeper look at it. But patient people don't jump at it because remember, the biggest power you have as a real estate investor is the ability to walk away. And that is patience, waiting them out and making them crawl back to the table instead of you. Hey, it's Jonathan. I hope you're enjoying this episode on cutting out the noise. And I don't want to add to the noise in the middle of this. I just want to say thank you. 365 episodes in. I'm not somebody who even tracks the numbers. I don't know anymore how many downloads I've had. I just know how many episodes there have been. And I assume at least one person's listening. So thanks for listening and tuning in and continuing this journey as we go into financial mindfulness, wealth generation, wealth preservation, because I think it will better serve you to get a more well-rounded view. It's going to be fun. Stick with it. Let's get back to the show. Let's see, why investors who won long-term were boring in the short term. I love that. When I create these, I create a list of 10 things to talk about. I really like this one. The most boring investors are the ones who win. Warren Buffett, Charlie Munger, boring, very boring, crush it. So in the beginning, other people may think they're boring and they don't care. They don't care in the slightest bit. They're just going to keep letting their assets compound. That's how you win long term, is you're okay with being boring. That goes back to the noise. If you're too attracted to the noise, you're going to want to be a part of the noise. And that means you're going to want to show off the things that you're doing. And that also means that you're probably not trying to be boring. You're trying to be flashy, unboring. You're trying to let people see all of your doors and count up your doors that you don't even own 100% of. And there comes the problem. Now you are a part of the noise. And once you're a part of the noise, you're in the funnel that is reacting to things that are more short term. If you make a 20-second video and you expect people to take some action off a 20-second video, I mean, good for you if you're that persuasive, but those people taking action are taking action on other things in 20 seconds too. So it's a kind of full profile for them to look through. I feel like boring is the foundation to long-term investing. Boring means patient. Boring means long-term thinking. Boring means relaxed, not going crazy over every single deal, taking the time and allowing yourself to lose deals. As I've said many times, there's plenty of deals that I should have bought and that I was close to buying or that I canceled and I should have bought, but I never felt bad. I don't have a deal that got away. Oh no, not even the slightest bit. If someone else does great on the deal, good for them. I really don't care because I had the confidence to make the decision to pass, and I'm not going to second guess myself on that. I can look back now and say like, if you go listen to my episode where I talk about my last 5 deals that failed, there's one that I say I should have got, and a second that I was like, I've probably been okay if I got it, but I'm not questioning why I did it. I know why I declined, and I'm okay with the fact that I canceled the deal. But if I held it, would it have been good? Yeah, but you can't win them all. Because if you're patient and you use your power to walk away, sometimes you're going to walk away from a good deal. Just got to live with it. And that's part of being a long-term thinker. Hey, good luck for the next person. I don't need to hop on every deal just to get into the game. So, how do you build a personal filter for what deserves your attention and what doesn't? I think it starts with your goals, where you want to be in 1 year, 2 years, 5 years, 10 years, 20 years, at 85. Where do you want to be? I think you need to build that out. And then you need to investigate your why. If you investigate your why, you're starting to build your personal filter. Because if you know what your why is, and you know what your goals are in the short term and the long term, you start to find asset classes and return structures that match that. And you may not know. It's okay to make some mistakes. You may think because you can make a lot of money as a house flipper. A lot of us have. Most people don't, though, because most people don't know what they're doing and they don't know the framework to flip a house. They don't know the costs. They don't know how to work with contractors. They're not good at design. Look at like 90% of the men who have no females helping or have no design sense of their own, just kind of like what I would call contractor grade, which, for some people is fine. Just doesn't really have much, pizzazz. And I'm not talking the pizzazz like 9 accent walls. That's not for me. But I think you build a personal filter also by being around other people who have strong personal filters. It's like if you don't have good boundaries in your life, it will help you to be around other friends who have very strong boundaries and they don't allow the noise in, because then it will encourage you for you to know that it's okay to block out the noise, or it's okay to not try to flip a house if you don't know anything about it, or not try to do like an RV park because it sounds like a good deal and the numbers on the spreadsheet look good, but you literally don't know anything about RV parks. To me, outside of, what is going to be more passive investments, if I'm thinking active investments, you can still be boring. What's boring? Turnkey is pretty boring. I don't think it's like always reliable, but that's pretty boring. And I think turnkey can be a pretty good wealth mechanism. You just have to get past the first couple of years. Because remember, you're buying in high normally on a turnkey. You're buying in higher than the neighborhood normally. Like you'll buy something for 100. The houses in the area, maybe they're like 85. Okay, so you're going to cruise along at that. You got to wait it out, because then they're going to knock out a couple more of the houses. Then maybe you're up to 120 in a couple of years. But where it really starts to get good is if you pick the right areas, that in 5 years, you're at 200 because you just waited and you took very okay rent. Maybe you're at 1% rule in the Midwest, and you're not trying to scratch to get more. You're just riding it along with a good tenant. That's also a patience thing and long-term thinking. If I'm a landlord and I have a good tenant, I'm much more likely to allow them to keep paying less rent, not rock bottom, but I don't need them to be at market value if they take care of the place and they handle everything. That's a great tenant, because that's a better spend. Your CapEx is going to be way less with a tenant like that. And that's another difference. Short-term thinking is, the tenant has a partner, I'm going to try to, upcharge them because now there's two people in. Then maybe just be happy that they found a relationship. And now you have two people watching over the place. Like, good can come of partnerships. You can't think of everything in this like myopic negative sense. There's a lot of good that can come from things that happen in the short term, but you have to think of them in the long term. So I think you build your personal filter by what information you take in against what noise you allow in. And also, I think you build your personal filter with your group of five, the five people that you spend the most time with. If you spend the most time with five people who don't think real estate investing is smart and they're not good with money, it's not going to help you. You got to work in, four of those five people have to be good with money and like real estate. They really do if you want to keep getting successful. And then of course you can have other friends, but I'm telling you, when you want to be in multiple investments and have a lot of passive income, if you want $10,000 of passive income a week, I guarantee you almost everybody has five people closest to them that also think like that, because that's what you gravitate to. And those are the groups that you gravitate in. So again, as we've done this transition, we're talking a lot about the phrase that I'm coining, financial mindfulness. I hadn't heard it before. I really like it. But what does it look like when everyone around you is making moves? So I think of it like meditation, which I've been meditating for more than 10 years, 30 minutes a day in the morning. And I don't sit with my legs crossed and my arms out. I meditate the way that I want to. Sometimes I meditate when I'm walking. There's lots of different ways, and you can listen to all of the meditation teachers talk about it. I'm not Buddhist, so I'm not trying to perfect it at this point. I meditate all sorts of different ways. Sometimes I'm lying down. Sometimes I do it before I go to sleep. I always do it in the morning. But the way that I think about it, if you think about the way you would see like a traditional meme of somebody meditating with their legs crossed and their fingers touching and their eyes closed and they're just sitting in peace, that to me is what financial mindfulness looks like when everyone around you is making moves. The way that I see it in my crazy little brain is one person sitting there on a mat meditating and everybody else making everything happen, but forcing it, forcing things to happen, changing the spreadsheet so the deal works, trying to keep up with the Joneses and having too much FOMO and just trying to catch up and keep up and be up with people that really don't care. They're just trying to get to the next level. It's just, that's how I see it. I can see it in my head that way with all the noise around you. Think of it like an airport. Have you ever tried to meditate in an airport, which I do? I sit in the chair, I close my eyes, I put it on as loud as I can in the airport, but I know that there's absolute craziness going on all around me. There's gate calls, there's babies screaming, there's people, drinking too much, there's people jamming sandwiches in their pie hole. There's literally everything happening at the airport. But as I lock in, the best that I can. It's not perfect. I can't tune everything out. It's just not possible. But I go to that place and I realize I don't have to be in the noise. And as we've talked about noise versus information a lot, this is how I want you to think of financial mindfulness. It just allows you to be confident and calm because you're projecting the right attitude, making the right decisions because you're thinking long term. You're not a chaser. We talked about this in the last episode. You never want to be the chaser. It's not good. It just never feels good because you want something and something's running away for you or someone. If you're chasing, someone's running away, something's running away, and you feel like, oh, it's getting away, I have to do more. If you're financially mindful, you say, you know what? I'm going to let that one go. Just let it run away. I'm going to focus on the next thing on my list, and maybe that will come back. And that's how I win a lot of deals over my career. I walk away because I know that's a power move, and I do not look back. I don't turn my head, nothing. I walk and I'm done. And if they contact me back, probably going to be a hard sell. Because I'm going to grind them if they come back. I don't just give in. I'm going to go to where I said I was going to go, which is lower, because I told them I was going to walk away. They didn't respect it. Then I walked and then they came back to the table. Well, there's a punishment for that. That's just the way that I think. Because again, if you go back to last episode, a couple episodes before, I want deals. I don't need them. And like I said, half the time I don't even really want them. I could take it or leave it. Any real estate deal that's out there right now, I could take it or leave it. When I'm buying a house for myself, I like some more than others, I just know there's other houses out there that I like. It's not that special. I can just fix it up. I've flipped houses my whole life. Like there's things you can do to adjust. So being financial mindful, I want you to think of the image in your head of what you think it looks like. Because to me, it's like that airport thing. I'm sitting there and all the stuff's happening around me, but it doesn't phase me. So if everybody's making moves, hey, good for them. I hope it goes well for you. I hope everybody does well. It's just not the case, but it wouldn't bother me if everybody did well. But I'm going to focus on myself and I'm going to stick inward. I'm going to stay at my core. I'm going to be confident in what I know. And if I don't think I know enough, I'm going to keep doing those tipping point hours until I get there and I feel that confidence enough to pull the trigger on a deal and feel good about it and not get scared and not get cold feet. Everybody takes a little crap when they win a deal, just a little one, but you have to know like that's just the anxiety talk. You're going to get through it because you did the due diligence on the asset and you know that it's the right call. I was going to go through a list of deals I didn't do because of noise and what happened to them. I mean, I've definitely made some wrong choices on deals. I think I've gone over that in other shows, but I think where I did the best about rejecting the noise was definitely when I started investing in syndications. I had so many syndicators on the show that after I would get off the show, I'm like, that guy was good. That woman was good. Like, I want to invest with them. But I really went through all the people and I've only invested with 3 different, well, one is a group. So I have 5 syndication investments, as everybody knows, if you listen to the show. 4 in multifamily, one's in a wellness hotel. The wellness hotel features 3 people that I've had on the show, 2 as a couple, and then 1 separately. And then the other syndications for multifamily, 3 are with 1 person I've had on the show. 1 is with 1 other person I've had on the show. So it's a very small group. And that's where I think I did a really good job of rejecting the noise, because I could have invested with almost anybody I had on the show. And there were definitely some others that were in contention. Some were higher buy-ins. So when I was starting, I didn't really, I didn't want to go higher than 100 grand. And some funds are like, 250 minimum. I didn't want to put that much into one deal. Now looking back, that's interesting to me, but I like being diversified the way I am just in case, because a lot of my friends and people I've had on, they're diversified 10, 12 passive investments, and some of them hit the crapper. Fortunately, knock on this wood, none of mine have. So I'm going to hope to stay that way, but it's because I rejected the noise. I didn't go for the easy one. I did my due diligence. I learned about it. I had conversations with them. I talked to them a long time on the podcast. I talked to them after. I did a bunch of research on the asset. I focused on the debt. That's how you reject the noise. I didn't go with the flashy, beautiful PDF that says an IRR that's very high. I honestly have no idea what the projected IRR was for any of the syndications I invested in, because it's projected. I don't care. It's only a projection. I want to look at the data. If we go back to the beginning, the difference between information and noise, I want to look at the data and decide for myself, is this a strong asset? Is this an asset that I believe in? Is this an asset that I'm going to enjoy being a part owner of? And am I proud to hold this asset in this area? And am I okay with whatever happens because I made the right decision to trust the right people? Not all deals are going to work out. Fortunately, so far, they have, but you have to be open to the modified risk. I think that I practice educated risk. And that means if something goes haywire, barring something fraudulent, going to have to live with it. And you're going to have to move on to the next thing. Last thing before we wrap this one up, what you would tell a new investor today about tuning out and thinking long. I mean, I think I've just said it all. Let's kind of boil it down. Build up your own knowledge, build up your own confidence, build it up through podcasts, books, people that you trust and believe in, people that aren't selling you something, that aren't trying to sell you into a $50,000 mastermind. Not to say that they're bad. Some of them are good and some of them are worth it. But when you're new and you're building confidence, you don't want the sell. You just want people who are there to help you. That's why, to me, the podcasts are great. You have no ask. You can follow the show. You can like the show. You can leave a review. honestly, I don't really care. I don't even look at the numbers. It doesn't really make any difference to me. I'm not trying to sell myself to Spotify. So none of that makes a difference to me. I just want you to hopefully learn one thing on every show if you're listening. If you walk away with just one tidbit that helps you at any time in your life, that's a win for me. That's why podcast is such a win. And that's why I'm at episode 365, because it's really the way that I think. If one person has one takeaway, it's a win. So what if 150 people have one takeaway? Then what if like 200 people have two takeaways from a show? That's incredible. That's why I listen to so many podcasts myself. I love it. I'm a high consumer of podcasts. I mean, a very high consumer. I listen to hours and hours of podcasts a week. And when they're not working for me, I shut them off. And then I go to another one. That's the fun of it. But what you have to do to tune out and think long is eliminate the noise. Not to say you can't have fun scrolling on Instagram or TikTok if you like that, whatever you enjoy, but you have to consider that, downtime. When you're in the mode where you want to learn something, you have to be focused. You don't learn something from TikTok like that. Not to say, again, that there's not information that's valid on TikTok. It's just not long enough. You're not finished. So say you're in a 30-second TikTok or a reel on Instagram, and it's something, it sounds like a great idea. You're not finished. It's 28 seconds. Now you have to go, and now the work begins. Is this a good idea? Who says it's a good idea and why? Is there other verification out there that confirms this is actually valid? Are there podcast episodes with this person or this asset class or this way of investing that I can listen to get different opinions on this? So even if you get a good idea in the short term, what it's really about is, what are you going to do with it? What are you going to do with it? Are you going to be a participant in your own wealth generation? Are you going to be the one who builds the foundation, or are you going to rely on others? And the reason that we kind of morphed the podcast is because I believe that me at the microphone and bringing on guests, can help you change your mindset around money and real estate to help you think better. I explained last episode, I'm working on the book Zen and the Art of Real Estate and Investing right now. It is not for everybody. It's built for people who want to think. The book is going to make you think. It's not going to give you the answers. I don't have the qualifications to tell you the answers to everything. If you ask me a direct question one-on-one, all my friends know I have an answer. It's the answer based on my experience. I can't guarantee anything's right. So I'm not writing a book to give you the answers to everything about real estate investing. I'm writing a book to help you think about what the best answer is going to be for you. That is financial mindfulness. And I hope you've enjoyed this, how to think like a long-term investor when everything around you is noise. There's so much noise out there. I hope you can start to use this episode to help you block it out. I'm excited for the new direction of the podcast. We're mixing up guest episodes with solo episodes. It's going to be fun. And I'm really glad that you're here for the ride. I'll see you next episode. Thanks for sticking around to the end so you can get a preview of who's coming up on episode 366 of Zen and the Art of Real Estate Investing. And it's the managing director of Rise 360 Ventures, Ali Nasir Ali. He brings a lifelong connection to the industry, combined with decades of hands-on operational expertise, commercial real estate appraiser coursework, and continued studies at Harvard University's Extension School. This is going to be a great show about Rise 360 Ventures and what they do, building wealth, elevated communities. We're talking manufactured housing and RV communities next episode.